Welcome back. In this video, we're doing some new bull-bear analysis on Palantir with the latest research from Dan Ives, as well as the newest concerns from the bears. And this is with Palantir currently sitting at $26 per share in 2024. We have current analyst rankings of an average price target of $20 per share, with the stock significantly above that. 40% hold ratings, 35% sell ratings, and 25% buy ratings. So let's get into it. Bull case from Dan Ives, street high of $35 per share as a 12-month price target, which coincidentally is also representing a 35% gain from where the stock currently stands. Before getting into their specific Palantir analysis, I wanted to show you this talk from Wedbush Securities about whether or not the sector itself is overvalued or if it's really just the beginning of something much greater. So the big investor debate, can this historic tech rally keep going? Our answer is yes. Over the last few weeks, meeting with tech investors in the US and across Asia, the big question we get from every meeting, can this tech climb continue after a robust start to the year and a historic 2023 run? Our answer is yes, as we believe it all comes down to the AI tidal wave. This is a transformational tech trend we have not seen since the start of the internet in the mid-90s, and for every $1 of spend with NVIDIA on GPUs, the multiplier around the enterprise and consumer space we estimate could be $10 plus over the next few years as this all plays out over the coming years. So is this a 1995 moment or a 1999 moment? Our answer is firm and confident. This is a 1995 moment, as now the AI revolution and $1 trillion of incremental spending over the next decade is hitting the software ecosystem and the rest of the tech sector. NVIDIA and the golden GPUs are the start of the spending wave, not the end, and now the street awaits as a myriad of use cases get built out across the enterprise and consumer ecosystem. This is the key dynamic, as the ROI on enterprise use cases are changing the growth profile for Nadella, Redmond, and the other big tech stalwarts, along with software leaders Salesforce, Adobe, Oracle, MongoDB, Palantir, and others. Jensen and NVIDIA have essentially cracked the code and sparked a new generational tech transformation that investors are trying to get their arms around. As someone that covered tech stocks during the dot-com bubble burst, this is nowhere near the 1999-2000 period in our view, as the sky-high valuations, lack of monetization, infrastructure, weak balance sheets, froth markets, and macro backdrop was in a totally different world back then compared to what we see today. Now, the focus for investors is identifying the second, third, fourth derivatives of AI play that's going to play out for the AI market over the coming 12 to 18 months. The first part of this puzzle was front and center the last few months as big tech stalwarts Microsoft, Alphabet, Meta, Amazon, and others cited accelerating capex for AI buildouts on their earnings calls over the last few weeks. Speaking to our view, the AI monetization is now underway, hitting the shores of the tech sector. Microsoft Copilot activity was well ahead of street expectations from Nadella and Co., and all signs from Redmond speak to Microsoft customers lining up to sign up for Copilot and AI developments, with NVIDIA's recent quarter guidance giving further confirmation to the thesis playing out during 2024. While the bears will continue to harp on valuations of NVIDIA, Microsoft, Palantir, MongoDB, and other AI pure plays, we believe investors have missed the biggest transformational tech stocks during the last decade, including Amazon, Netflix, Meta, Apple, Alphabet, among many others, have dogmatically stuck with the forward PE valuation approach on these tech stories. For the elite transformational tech stories such as NVIDIA and the AI revolution, investors must see the forest through the trees to where this enterprise spending wave and estimates can head over the next 3 years. So for specifically talking about Palantir, I thought that was important context, what I just went through. But now their note on Palantir and why they raised their price target by $5, let me read this analysis for you. We are raising our price target of Palantir from $30 to $35 while reiterating our outperform rating. Our recent checks on Palantir in the field have been incrementally more bullish, as we believe the AIP Foundation is becoming viewed by many U.S. enterprises as the launching pad of AI use cases. This was on full display at aipcon this week, as Palantir has quickly established itself on the enterprise front as a clear leader in the AI arms race with AIP front and center. With the AI revolution now quickly heading towards the key use cases and deployment stage, Palantir, with its flagship AIP platform and myriad of customer boot camps, is in the sweet spot to monetize a tidal wave of enterprise spend, now quickly hitting the shores of the tech sector, in our opinion. Customers across industries are continuing to find use cases with AIP, creating major cross-sell opportunities in the pipeline. With clients able to significantly increase productivity with the Palantir suite, this ultimately leaves additional room for scaling as efficiencies increase with what we've seen firsthand from customers. Overall, we believe Palantir is on the golden path for its monetization story on the commercial side and is well positioned to capitalize on the strong commercial spending tailwinds for 24 and 25. With a strong product portfolio coupled with AI, we expect Palantir to garner a meaningful share of what we believe to be a $1 trillion AI global TAM as enterprise and government ecosystems rush to implement useful platforms for automating complex workflows. AIP is a game changer, Titan just the start, in eye-popping uptimes with customers that we spoke with over the last few months, completely and fully integrated between 1 to 4 weeks of signing papers, an impressive feat that speaks to the Palantir AI vision now playing out in the field. Palantir is continuing to pioneer and guide customers to deploy products, optimize workflows, and produce operational results at industry-leading rates while incorporating privacy protective features. We believe as the AI revolution takes hold, Palantir sits in an enviable position to monetize customers both on the enterprise as well as government segments. With the Messi of AI winning the landmark $178 million contract this week to produce Titan, the United States Army's next generation targeting node, this could now unleash a host of more government deals to ink over the coming year as Palantir becomes the solution to beat within Beltway and DoD-driven AI deals. It is clear that as AI use cases explode, enterprise CIOs are looking towards Karp and Co. as the AI golden child for a platform to build out AI frameworks for the future. As we've discussed, this story, growth, and ultimate re-rating is around Palantir's U.S. commercial business, which is estimated to show growth of at least 40% in 2024. As the commercial business ramps at this massive pace, free cash flow could approach $1 billion in 2024. With this margin cash flow story just beginning, Palantir remains an undiscovered gem and a core part of our thesis in the AI revolution just now taking shape across the tech world. We believe AI is a 1995 moment, and this spending wave, along with the AIP Foundation, puts Palantir in a prime position to monetize AI demand and use case build-outs in 2024 and beyond. So their valuation and price target of $35 per share represents 11 times their fiscal year 2027 revenue of $5 billion in their bull case scenario. To take a look at the average consensus target for revenue in 2027 and saw it's about $4.1 billion in 2027. So Dan Ives slightly more bullish with about $1 billion higher revenue in 2027. I wouldn't say this is out of the question, but it's definitely a decent bit higher and is what contributes to the expectation that Palantir is currently fairly undervalued at this moment. So hopefully that was a helpful read through. Now I want to switch over to the bear case. William Blair reiterating their underperformed target. In line with their previous note, Palantir's solution was indeed chosen to advance for the Titan program with a $178 million two-year contract. Shares were trading up 9% and then fell back down slightly. They say, "We believe this contract was largely already in guidance. As a result, we're not raising our estimates for this contract, and we do not believe other analysts will be adding a prorated $89 million to their 2024 numbers in notes analyzing the Titan contract." They say Palantir's 2024 revenue guide of $2.65 billion to $2.67 billion is remarkably still well below where sell-side analyst consensus expectations were in January 2023 of $2.81 billion. So I would just jump in here and ask why they're looking back in January of 2023, well over a year ago at this point. I don't understand how that could be helpful analysis to be looking so far in the past when you should be looking in the future. But nevertheless, they say when Palantir shares were trading in the $6 to $8 range, and they're essentially saying that if the full contract value was added, the guidance would still be below what analysts are expecting Palantir to achieve. So what they're missing here is multiple expansion across the board. The industry multiples have increased significantly, which is why Palantir's $6 to $8 range now looks cheap compared to where it is currently where it may have looked fairly valued back then. So I'm not too impressed with the William Blair analysis here. But what they go on to say is you can make the argument that the stock overreacted a bit on that news. Palantir is not vertically integrated for this type of work and must pay its disclosed partners. The financial profile of this type of contract will likely be similar of defense prime contracts for other Army ground vehicles. And they go on to say how the economics are not too impressive for this deal, and how government customers represent 60% of Palantir's revenue. And one example of a government contractor, General Dynamics, is valued at 1.7 times revenue, while Palantir is 10 times that at 18 times revenue, which of course is not a fair comparison because of the commercial business. But nevertheless, they say Palantir trades at 18 times our 2025 revenue estimate with 19% revenue growth. Over the next 12 months, we expect Palantir's multiple premium to narrow as a result of competitive pressures from new defense contracts. I'd love to know what they're thinking about there. And slowing commercial growth, that seems very unlikely at this point. But again, I am biased. Accordingly, we reaffirm our underperform rating. Would be great if they gave us a price target, but they seem unwilling to do so. They say risks to the downside include competition from government and commercial vendors. Risks to the upside against their narrative include optimism associated with the impact of artificial intelligence on Palantir's business. So rather than just talking about what they have to say, let's get down to the very specifics. Is Palantir overvalued or are they not? So this is Palantir's valuation metrics versus, you'll see listed as benchmark, the S&P 500 software is what I selected to do a comparison for Palantir. So here is back in 2021 for September all the way through December of 2023, where we got Palantir's latest quarterly results. Price to sales for Palantir in 2021 was 33 times when the industry was at 14. Fast forward to today, Palantir's multiple has compressed to 18 times and the industry is at 13. So I'd say definitely some good progress there. Palantir's multiple has contracted. It's not expensive as it used to be in 2021, and the industry multiple has contracted as well. Let's look at price to earnings. Palantir was unprofitable in 2021, but the industry was trading at 46 times. The industry is now trading at 45 times, pretty flat. Palantir at 190, but we know that's going to rapidly decrease as their growth accelerates because they have such little earnings at this point relative to where they will be in the future. So it's not worth criticizing the price to earnings ratio as it is currently. Price to book is interesting. It says Palantir is undervalued on a price to book basis, but not very important. It's just because they have so much cash is basically how I would explain it. And let's look at price to cash flow. This is a good example of what their price to earnings is going to do over time. 213 times cash flow in 2021, and now they're only 57 times cash flow right now with the benchmark at 33. And so that's an example of what's going to happen as companies grow and their earnings grow. As a result, their price to earnings multiple decrease radically, which means the actual stock price has to increase, or it's going to look and be very cheap and it's going to be a value stock. And so I don't think Palantir is going to be a value stock for a very long time. I think it's going to maintain a premium multiple for at least a decade. So all of that to say, it's a good example of what is to come. No dividends. And let's just take a look at one more. Maybe enterprise value to sales used to be 32 times. Now it's 15 times. And it's pretty close to the benchmark for enterprise value to sales. So I'd say across the board, you can certainly pick and choose between what you think is fairly valued, what you think is overvalued. But overall, it really fits your narrative with what you're going for over the next 12 months. It's anyone's game. Palantir could go back below $20 per share. It could hit Dan Ives' target, $35 per share. It could stay flat. But it's worth noting that that is just the short term, and you want to think longer term than this. So when you see analysts talking about their 12 months target, have that in context. I'd love to know what you think about Palantir's next 12 months, and leave your expectations for Palantir's December 31st, 2024 stock price in the comments below. Until next time.